This chart shows the valuation of IBM stock, experiencing a sharp 13.2% drop in a single day in February 2026. The market reacted to a specific exposure. Investors realized that traditional technology consulting relies on billing for time and materials. When autonomous AI begins modernizing code bases and running workflows in a fraction of the time, the billable hours collapse. The market now actively penalizes revenue models vulnerable to this efficiency. Capitalizing on this vulnerability, a coalition of private equity firms, including Blackstone, Hellman & Friedman, and Goldman Sachs, launched a $1.5 billion venture in May 2026, powered by Anthropic's AI. Instead of selling advisory hours, this venture targets operating companies in the $1 to $6 billion revenue range. It embeds engineers directly into these mid-market firms to capture the upside of the automation themselves. Legacy systems integrators face a mathematically unavoidable choice. They either discard the hourly billing model and capture the value of the outcomes they generate, or they accept permanent financial compression. The core mechanism of AI deployment creates an operational paradox for traditional consultants. Sovereign agents and digital twins compress a client's standard workflow cycle from 67 days down to an average of 18 days. Under a legacy contract, solving a problem faster means recognizing less revenue. Efficiency directly cannibalizes the consultant's own margin. To survive this, internal strategy dictates the creation of a specialized ring-fenced unit, an AI strike team. This team's mandate is to secure outcome-based contracts and monetize the resulting efficiency before external private equity captures those clients. To execute this, massive consulting firms must systematically bypass their own corporate structures to deliver verified financial outcomes at speeds matching their well-capitalized competitors. The strategic battleground is the $1 to $6 billion mid-market. Companies of this size lack deep in-house engineering capacity, but their executive boards make decisions in a matter of weeks, completely bypassing the procurement cycles typical of the Fortune 100. This matrix details capabilities required to win on an outcome basis: sovereign AI, physical edge networks, digital twins, and independent certification. Private equity startups have capital, but lack the hardware and auditing panels. Legacy competitors possess infrastructure, but remain anchored to time and materials. Capturing the mid-market requires fielding all 7 operational capabilities at exactly the same time, allowing the firm to deploy massive technological upgrades with zero upfront capital risk to the client. The mechanism to execute this is a productized dual-phase delivery architecture known as the 2-tower model. Tower 1 is a 90-day sprint. Engineers lock down a computable, real-time digital twin of the client's operations, using drone fleets and edge sensors. In a live production environment, BMW used this exact twin architecture to simulate new vehicle layouts, compressing their factory validation cycle from 4 weeks to just 3 days. Connecting the 2 phases is a strict audit gate. An independent governor panel verifies the exact financial uplift against ground truth telemetry. The integrator does not recognize a single dollar of revenue until this third-party certification is complete. Once certified, Tower 2 activates. This is a multi-year annuity stream based on the verified performance. For instance, the Perigo manufacturing deployment generated over $397 million in total contract value, entirely through outcome-based gain sharing. This delivery architecture reclassifies artificial intelligence. It transitions from a speculative expense into a recurring financial asset. Building the technology stack is entirely solvable. The structural threat blocking massive integrators from capturing this revenue is their own internal operational velocity. A standard master services agreement in a global consulting firm takes an average of 8 to 12 weeks to process through sequential legal reviews. This chart visualizes the cost of that timeline. Based on the target run rate, every single week of internal administrative delay costs $4.2 million in compounding recognizable revenue. Furthermore, traditional account structures separate origination from delivery. Sales teams are incentivized to book contracts that the engineering teams cannot mathematically execute, eroding margins and destroying client trust. Internal approval gates and misaligned compensation models cost integrators more money than any external competitor in the market. The operational answer to internal friction is the strike team, an 11-person, fully ring-fenced unit combining origination, delivery, and certification into a single structure. This unit operates with executive bypass authority. They're granted permission to skip standard sequential procurement gates and utilize pre-approved legal templates, cutting contract execution down to 30 days to match the speed of the Anthropic venture. The incentive structure is entirely unified. The team receives a 1% carve-out on the total contract value, paid out only after the Governor Panel publishes the certified financial outcome. Sales and engineering share one absolute metric of success: audited EBITDA. The team operates two engines simultaneously. They hunt mid-market lighthouses directly, and they plug into existing Fortune 500 accounts to supply the outcome-based capability that traditional relationship managers cannot build on their own. The strike team bypasses internal corporate friction to ensure the firm's contracting speed is equal to the technological capabilities they are selling. Executing this model generates a compounding effect. Certifying outcomes for one company historically produces a pipeline multiplier from direct competitors. Locking in a verified outcome for Brinker International establishes the proof point to open active procurement conversations with peers like Darden and Aramark. This pipeline multiplier drives severe baseline economics. Securing 12 mid-market clients over 36 months projects a base case total contract value exceeding $456 million. Audited, outcome-based AI delivery creates a compounding revenue flywheel that legacy T&M models mathematically cannot replicate. The financial friction required to ignite this model is deliberately low. Operationalizing the team, acquiring the edge hardware, and retaining the audit panel requires a ring-fenced budget of just $4 million. The model's structural design focuses on high-leverage recovery. Even if the team fails to meet its quota by 50%, the strategy is projected to yield a 42 times return and self-fund within 7 months. The private equity competitors have already launched their offensive on the mid-market. The integrators have a rapidly closing 90-day window to establish the industry standard before the startups generate their own reference clients. The future of enterprise technology delivery abandons software reselling entirely. It demands the industrialization of radical operational visibility and autonomous execution, underwritten at every step by independent financial audits. Integrators that survive this transition will actively dismantle their own internal bureaucracy, executing at the speed the market